tenemos una entrevista que nos hace mucha ilusión, entrevista presencial con BNY Mellon. Enseguida les presentamos a nuestro entrevistado porque vamos a no solo analizar las últimas palabras, los últimos mensajes de Jerome Powell e intentar pues establecer esa fotografía general, ¿no?, de en qué punto nos encontramos cuando hablamos de la política monetaria de Estados Unidos, cuando hablamos de su situación macroeconómica y sobre todo de cómo se está llevando a cabo esa lucha contra la inflación, sino también porque vamos a posar la mirada sobre oportunidades de inversión con la gestora. Y me acompaña, como digo, Andy Warwick, es cogestor del BNY Mellon Global Real Return Fund. Andy, thank you so much for having us this few minutes in Negocios Televisión. A pleasure.
Pleasure.
Andy, it's important to highlight some of the main Powell messages in his appearance at the Senate. It seems like he has softened a little bit his message after telling yesterday that the Fed will have to tighten further its monetary policy. The Fed has a tough job. We know that, but how do you see this? Do you think Powell is trying to tell us that the next movement will be at 50 basis points?
To be honest, I don't think the Powell or the Fed have any clue about what's happening. It was only a month ago that after the Fed rate rise that Chairman Powell was lauding about disinflation, believing his own hype that he was going to manage the most perfect soft landing. It's never happened before, but he was of the belief it was going to happen. And then a month later, we have worse CPI, PPI, PCE, and of course now, yesterday, as you said, he's got to turn around and act tough again. I think the markets rallied extensively last month, and obviously we had a sell-off today. That makes him probably very uncomfortable, so no surprise to see a minor pivot again, a softening of his stance today. But ultimately, the Fed, as you said, got a really tough job, right? They've got an inflation rate that's kind of not going to get anywhere close to their target of 2. They've got an unemployment rate now that is at a 53-year low, and that's baffling them because history tells you that when you raise rates, surely it has an effect. So, yeah, tough gig he's got.
Yeah, we have to remember in the last monetary policy meeting in February, he talked about a disinflationary process, and maybe he was too optimistic telling us that Powell has told to senators that he can raise interest rates and avoid a significant rise in the unemployment rate, and he can avoid a recession in the US. Do you think he is being too optimistic telling this?
Well, it's a good question. I think actually there is a chance that could happen. And what we could see is actually that Main Street escapes a recession because the economy is so strong, but Wall Street suffers a recession because costs and margin pressures are too great for them to deal with. That could be the case. But look, our view has always been that we have transitioned now to a new regime. The market still hasn't got this idea. It still thinks that this is transitory, that the Fed will manage inflation down, and then we're back to the previous decade where you just buy FANG and rates go down to 2. This is a new world. This is a new financial regime. This is the 70s, albeit with slightly different flavour. That means that there's very little chance of the Fed getting inflation down to 2 unless they become incredibly aggressive on rates. And we're talking 8, 9, 10. Highly unlikely to do that because you've just heard how dovish he is still trying to manipulate this market. So that just means I think that inflation ultimately stabilises at 3 to 4%, and there's some pretty explicit implications for that, particularly with equity valuations in the US, which are still way too expensive if that is the case. They're pricing in the super soft landing. I suggest that they need to reprice something a little bit more severe than that.
If inflation doesn't go towards this 2% target, do you think the Fed occasionally could change its inflation target?
I think that would be the obvious thing to do. I think if they did that right now, they'd lose all credibility, if they have any left, after the amount of Fed pivots we've had. The bond market would not like that at all, because it would mean that inflation expectations would become unanchored. However, I do believe at some point, maybe in the next year, 2024, when the realization that inflation is just not getting down to 2 and we're stabilizing around 3 to 4, that would be a course of action the Fed could adopt, and that would give them some movement and latitude. The problem is that the bond market will then have to price in a term premium, which we haven't had since the GFC because of the amount of market manipulation by the Fed in terms of financialization. So the bonds will reprice higher. So that's a dangerous one. I don't want to lose control of that. But yeah, if I was the Fed, I'd be waiting for that for 24.
You mentioned that unemployment rate now it's at 3.4%. This Friday we will know how it's been the evolution of this rate. What can we expect, and what can suppose new unemployment rate in these levels, 3.4, 3.6%? What can it means for the Fed?
I think it's tricky. I think this time round is different in a way, and that's a terrible phrase to use in markets, right? But I think actually it's the shortage of labour that we've had since post-COVID that is causing this issue. And if you're an employer, it takes so long to hire people with the skills that you require. Like history tells you that the US corporates, when you get a slowdown, they sack a lot of people. And then because their employment laws are nowhere near as tight as Europe, and then they rehire them when you come out, right? And that works all the time. It's why, from a capital perspective, the US corporates are very efficient, or have been. This time round, if it's taking you 9 months to hire somebody, are you going to sack them straight away? Probably just to weather through the downturn. Probably not, right? So what you're going to do, you're going to hoard the labour, and that just hits your margin. So your costs are going to be way too high because there's cost pressures, inflation is constantly at 3 and 4. Your revenues may come off slightly as well because as rates get tighter. So as a corporate, that's why I say Main Street could avoid a recession, but Wall Street gets a recession, and it's an earnings recession where we have to reassess how strong these earnings are going to be because they cannot take the cost side down.
That's so interesting. If we talk about terminal rate, Powell has been asked in the Senate if terminal rate could be higher than 5.5%. The dot plots Fed pointed to 5.1, but when we are seeing how markets are pricing it higher, because according to Powell, last data suggests the ultimate level could be need to be higher. So what do you think?
Well, I don't think the terminal rate actually means that much unless it's a crazy number, right? Yeah. Whether it's 5, 5.5 or 6, it kind of doesn't really matter very much. What really matters is how long you stick at that number for. And so if you think about, like, in January this year, 2 months ago, the market was pricing in the Fed to be cutting rates in the fourth quarter this year, and then to go down to like 3% by the middle of next year. And every time there's been sort of worse inflation data, the market's just priced that a bit further out. So the question is, if rates get to 5.5 and they stay there for a year or 18 months, that's the worry, that's the impact, because you're going to have all these companies that are going to have to refund themselves when they come up for their debt at a rate that's now 500 basis points than it was 2 years ago. And many of these companies, particularly higher yield companies, are going to really struggle. They're barely making interest rate cover at the current rates. So that's when the pressure rises. So I don't think the terminal rate is so much of an issue. It's how long does the Fed need to keep it there to keep inflation tame?
If we talk about investment opportunities after this chaotic 2022, in 2023, of course, we have some of these uncertainties that worried us during last year. But now, if we have to put the focus on something, some assets, which is your perspective?
Yeah, well, I said this is a new regime, right? We've morphed from a deflationary growth regime of the past 40 years to a more inflationary regime similar to the 70s. And for the first time, I think, for the first time in probably about 20 years, I think you can actually start buying European banks and Europe as a whole. And the US versus Europe outperformance the past decade has been astronomical. It's so stretched, it's incredible. And I think what you're going to see over this next decade is Europe catch up to the US. Now, Let's be frank, the US probably have some of the highest quality companies in the world. That's fine. So you would expect some outperformance. But the valuations you're paying now for US equities versus European equities is extreme. Some European banks are trading still at sort of 7, 8 times earnings, throwing off 6%, 7% yield. These guys could be earning 20, 25% earnings growth. The market has mispriced that because the market is still pricing the banks as last decade's uninvestable asset class. So I think that's a really interesting area. The other one I think is oil for the long term, oil and gas. Hasn't had any capex for 12 years. No one loves them, but they are absolutely cash rich. They're not going to do any capex because they've been told not to. You need to move to a greener energy environment. So they're just getting cash constantly through cash flows, and they're going to be paying that out to shareholders through dividends and share buybacks. We've already seen that with companies in the UK, Shell and BP. That's an area, yeah, we need oil. If we want to transition to a greener environment, which we all do, we need oil to get there. And unfortunately, we haven't got enough of it.
Any advice about how hit or survive to the volatility we have right now in markets?
Yeah, I think it's a good question. I think you have to respect the ranges, and that goes for equities and bonds. So if you think about, let's say the S&P 500, the same applies to, say, Euro Stoxx 50. The S&P 500 this year is probably going to be in a 36 to 4,200 range. And you have to be respectful of that. And so, yeah, when we're up at that upper end, that 4,100, you probably should be lightening up on equities. And as we get down through 39 and lower, as we will inevitably this year, you need to be actually buying some of that stuff. You need to trade it. The same with bond yields. I think this year, the Fed is desperately not to lose control of the bond market. This is why you're seeing this kind of really hawkish and then a little bit dovish. And so if you use the US 10-year, maybe 3.25 to 4.5, that 125 basis point range. Again, you're selling your bonds when we're getting down here, you're buying them up here. You've got to respect, that's how I think you manage the volatility. I think the real challenge is probably 2024 and 25, because that's the point. I think that if we have still decent growth across the world, and it might be more synchronized because we're all out of sync at the moment. China's the last one because of the lockdowns. What happens if we get synchronous growth and inflation starts moving up to 5? What do central banks do? Do they do what you suggested and maybe rechange the target to 3 to 4, in which case the bond market's got to reprice? Or does it cause something to break because they have to keep pushing rates up? So that's more challenging. This year, I think, yeah, embrace the volatility, embrace the ranges.
Well, we will embrace it. Thank you so much. This is the dilemma we have right now on the table. Andy Warwick from BNY Mellon Global Real Return Fund. Thank you so much. It's been a pleasure.
Thank you.
Así que nosotros nos quedamos, como decíamos, pues con todo este análisis.